Sports today are bigger than entertainment. They're an interconnected economic universe where billions move every year. Every match, every tournament, every transfer, every contract negotiation, every draft pick, every knockout, every sponsorship, none of it happens in isolation. Behind the goals, touchdowns, dunks, sixes, medals, and knockouts are financial structures that shape the decisions athletes, teams, owners, broadcasters, agents, and leagues make. Whether your passion is football, American football, basketball, cricket, athletics, or combat sports like MMA and boxing, understanding the finance changes how you watch the sport. Today, we break down the most important sports finance terms everyone should know. We'll give clear, detailed explanations, real-world context, and practical examples so you can actually use this vocabulary when you read the news. By the end of this video, you'll understand the financial engine behind the global sports world better than most fans and better than a surprising number of industry insiders. Before we get started, take one quick second to like this video, subscribe to the channel, and ring the notification bell so you never miss our deep dives into the business side of global sports. It really helps the channel grow and keeps you informed every time we break down the money, powering your favorite games. All right, let's get started. Let's start with some universal money terms. These are the foundation terms you'll hear in headlines and boardrooms. Learn them once and they apply across leagues and sports. First, salary cap. A salary cap is the maximum amount a team may spend on player salaries in a season. It keeps leagues competitive by preventing the wealthiest owners from hoarding talent. Caps force long-term planning. Teams think years ahead to avoid running out of cap space during a title window. Then, soft cap versus hard cap. A soft cap includes exceptions, mechanisms that let teams exceed the limit in controlled ways. The NBA uses a soft cap with bird rights that encourage continuity. A hard cap cannot be broken, no exceptions, used by leagues like the NFL to enforce strict fiscal discipline. Now, luxury tax. When a team goes over the soft cap, a luxury tax penalizes them financially. This tax is often redistributed or used for league programs and makes overspending painful. In some seasons, the tax bill for a single team can reach 9 figures, so owners weigh championships against huge tax payments. Guaranteed money comes next. Guaranteed money is what the player keeps, no matter what injury, cut, benching, those dollars are theirs. In injury-prone sports, this is the real measure of a deal's value, not the headline salary. A signing bonus is an upfront payment that sweetens a contract and can be spread over several years for cap purposes. Teams use it to shape cap hits without inflating yearly base salary. What of incentives or performance bonuses? These are conditional payments for meeting targets, goals, appearances, medal wins, knockouts. They allow teams to reward performance and protect against paying for potential that never materializes. Revenue sharing is a system where a league pools certain income, like broadcast money, and divides it so smaller market teams remain viable. Revenue sharing is a balancing act. Too little and small clubs die, too much and big clubs lose incentive to invest. The CBA, or Collective Bargaining Agreement, is the master contract between players and leagues that sets the rules. Salaries, draft rules, free agency, discipline, health benefits. Major changes in sports almost always happen through CBA renegotiations. Broadcast rights are when networks and streaming platforms pay huge sums for the right to show games. Broadcast deals fund leagues, raise player salaries, and shape season structure primetime windows. Kickoff times and tournament formats are driven by TV money. Gate receipts, or matchday revenue, consists of ticket sales, food, VIP suites, and in-stadium merchandise. This is the matchday economy. For clubs with iconic stadiums, it can be a consistent, high-margin revenue stream. Sponsorship deals are when brands pay teams, leagues, and events for exposure. Jersey logos, stadium naming rights, pitch-side boards, and digital placements. These deals can be long-term and strategic partnerships that outvalue short-term gate spikes. And finally, endorsements. Athlete-level deals where the player promotes a brand for cash. For global superstars, these deals frequently out-earn their sports salaries. Football's global transfer markets and long club histories create unique financial terms you'll rarely see in other sports. Starting easy with the transfer fee. A transfer fee is the payment one club makes to another to buy a player who is still under contract. These fees reflect age, potential, contract length, and commercial value. Transfer add-ons are conditional payments, extra cash paid if the player hits target, milestones like appearances or trophies. They reduce immediate financial risk for buyers while rewarding sellers if the player succeeds. A release clause is a contractual number which, if matched, forces a club to allow the player to negotiate with the buying club. It provides a transparent exit price and often reflects player leverage. Now, about transfer amortization. Clubs often spread a transfer fee across the length of a player's contract for accounting. That big £100M headline becomes a more manageable £20M per year in club accounts on a 5-year deal. Parachute payments are, when a team is relegated, parachute payments cushion the revenue drop to avoid immediate collapse. They give clubs breathing room to adapt to lower TV and sponsorship income. Financial fair play, or PSR, rules now. Regulators like UEFA apply rules to prevent clubs from spending far more than they earn. These rules aim to promote sustainability and prevent risky, debt-fueled growth. Lastly, image rights. Players often control separate image rights agreements for marketing uses of their likeness. For megastars, image rights can be structured through separate companies to maximize tax and commercial value. NFL or American football terms now, starting with dead cap money. Dead cap occurs when previously guaranteed payments still count against a team's cap, even if the player has left. It reduces financial flexibility and can be a lingering burden for years. Next, franchise tag. This 1-year designation locks a top player in for a season at a high salary to delay free agency. It's a tension point. Players want long-term security, teams want temporary control. Now, rookie scale contracts. Drafted rookies receive pay based on draft slot, limiting rookie pay, and providing cost certainty for teams. It prevents unproven draft picks from commanding excessive early salaries. Now, cap hit. The cap hit is the amount a player's deal counts against the team's salary cap in a given year. Teams juggle cap hits with restructures, extensions, and bonuses to balance short-term success with long-term health. Finally, void years. Clubs sometimes add void years to a contract to spread a signing bonus and reduce immediate cap pressures, though this creates future cap liabilities. It's a tool that adds short-term flexibility at long-term cost. Now, let's feed our hoop dreams with some NBA or basketball terms. Starting with the max contract. The legally allowed maximum a player can earn under league rules based on experience and performance. It keeps superstar pay structured while allowing elite talent to be rewarded. The supermax contract is a special, larger paycheck for players who qualify through achievements like All-NBA teams or MVP awards. It's designed to help teams in smaller markets retain homegrown stars. Bird rights is a rule that allows teams to exceed the cap to re-sign their own players, encouraging continuity and team building. Without bird rights, teams would lose more players in free agency. Then, NIL deals, college sports. Name, image, and likeness rules let college athletes earn money from endorsements, while remaining eligible to play. This has changed college sports economics. Suddenly, college players can be regional or national brands. Finally, revenue versus non-revenue sports in universities. Major sports like football and basketball drive university revenue, which then subsidizes smaller programs affecting scholarships, facilities, and overall athletic department viability. Now cricket, starting with the central contract. Cricket boards offer guaranteed annual pay to top international players to secure availability, financial stability. These contracts often have grade tiers, A, B, C, with different pay scales. Then, match fees. Players earn per-match payments that differ by format. Tests usually pay most, then ODIs, then T20s. For boards with less commercial revenue, match fees are crucial income. Franchise leagues pay retainers to keep players available for long tournaments and preseason preparations. These ensure franchises can plan with a core squad in place. Now, auction price. In the IPL, players go to auction, bids rise in real time, and the highest bidder wins. Auctions create market-driven valuations and occasionally huge earnings for breakout talents. Finally, franchise fees. Team owners pay to join the league and operate a franchise. This fee underpins league expansion economics and long-term investment returns. The world of athletics also has their own unique lingo, starting with the appearance fee. Top athletes are paid to appear at a meet. Organizers pay these fees to ensure star power and ticket sales. Sometimes the appearance fee exceeds first-place prize money. Then, prize money. Payouts for placing at major events vary widely by competition and country. Consistent top performers often rely on a year-round schedule to earn a stable income. Then, shoe contracts. Shoe and apparel deals with major brands are the backbone of many athletes' earnings, sometimes bigger than all competitive winnings combined. Finally, performance bonuses. Sponsors and national federations often pay bonus sums for medals or record performances. These incentives drive athlete scheduling and target setting. The last sport we'll be looking at is combat sports, starting with fight purse. The base guaranteed money a fighter receives to show up for a fight, often split between base purse and win-related amounts. The purse signals a fighter's marketability and negotiating leverage. Next, PPV percentage, or revenue share. Top fighters negotiate a slice of pay-per-view revenue. This is where the biggest payouts happen. A massive PPV buy can transform a fighter's income from 6 figures to 8 figures overnight. Then, win bonuses. Common in MMA, fighters often receive a win bonus layered on top of a show purse. Win bonuses reward competitive performance and add risk-reward dynamics to negotiations. Now we look at sponsorship patches. Logos on shorts and robes. Boxing generally allows more sponsor freedom than league-contracted MMA fighters. Patches can be lucrative, especially for fighters from countries with strong boxing markets. Then, gate revenue. Ticket sales from the venue. Big gates increase bargaining power for promoters and fighters. Finally, purse bids. If promoters can't agree, the bout goes to a purse bid. Promoters bid for the rights, and the highest bidder hosts the event. Fighters then receive percentages based on the governing rules. Sports are more than games. They are a complex global economy, a marketplace of talent, media, and brand value. Understanding these financial terms gives you the power to analyze transfers, read CBA changes, evaluate fighter pay, and decode headlines with context. If this breakdown helped you, please like, subscribe, and ring the notification bell so you never miss an in-depth explainers like this one. Thanks for watching, and I'll see you in the next deep dive.